In this module, we're covering what's my tax, how to calculate your income tax. It can be one of the most daunting aspects of being self-employed. It creates fear and confusion, and those are not good feelings. Those create a lot of worry, and I'm promising you this is going to be easy. It sounds odd to say it's easy because, we have tax consultants. There's people who are paid a lot of money and base their whole careers on tax guidance. And I'm not for 1 second saying not to consult with people like that. What I am saying is your income tax, how that's calculated, is very similar to when you were an employee. And I swear people spend more time examining their payslip when they were an employee. They would look in minute detail at how they got from that gross figure to that net figure. But then when they're self-employed, it's like they don't pay any attention to those calculations when you should actually be paying even more attention. And we're going to go through in this module exactly how you can arrive at those numbers. And just because there are people that have a career made on this, don't let that intimidate you. It doesn't mean that you can't gain a very good understanding of your own taxes. In this module, you're going to learn about employee income tax versus business owner tax, sole trader or partnership income tax, director of a limited company income tax. And just to let you know, they're all calculated in exactly the same way. So let's look at the 3 different types of scenarios. So you've got an employee's wages, and that's essentially whatever has been negotiated with the employer. Then you have sole trader or partnership, and what their salary is the profit of the business. So it's the turnover minus whatever business expenses equals the profit, and that which you would have learned in the What's My Profit module. And that profit represents the salary or the income that's now going to be taxed. And then for directors of a limited company, they are similar in many respects to an employee, but it's also based on what the company's profits can afford. So a director is an employee of the company, and what their salary is based on what the company can afford. But in all 3 cases, you get to the same figure, a number that represents the gross wages or the salary that we do the tax calculation on. The big difference between being an employee and being self-employed is when you pay the tax. An employee, as you know, it's PAYE or pay as you earn. So in every pay slip, you've been given your net pay and you don't have to worry about your taxes anymore. That's it, done. Sole traders, on the other hand, each November, the sole trader will pay their income tax based on the profits they made in their previous accounting year. A director of a limited company, you are actually an employee of the company, similar to any of the other employees. And it's an excellent discipline to get into, that you decide a salary that the business is going to pay you as a director, and you just include yourself in the payroll, every payroll run, and you transfer that net pay into your personal account. We will discuss corporation tax later. I'm just going to labor the point a little about the limited company director pay. As I said, a director is an employee, same as any other employee within the company. And payments made to the director treated as salary, and they go through the payroll system, just like any other employee. If you have a limited company and you are behaving the same way that you were as a sole trader and just kind of grabbing money here and there as it's available, I would encourage you to stop that and to adopt a discipline where you are an employee and you have an agreed salary every week or every month whenever you're doing the payroll, and that money is being transferred then to your personal account. Limited company profit is calculated after the director's salary has been taken out. You, just like we said, you're an employee, same as your other employees, and that will be included in the profit calculations, which again we would have seen in the module on What's My Profit. Any remaining profit after the directors have been paid their salaries is then subject to corporation tax, which is at 12.5%. And, that sounds great, but just remember that if you as a director want some of that money after the corporation tax has been paid on it, you are, you're still an employee, so anything you take will be taxed at income tax rates. Now that we have a gross figure, we're almost ready to start our tax calculations. There's a few other things that we need. In Ireland, we have a low taxation rate and a high taxation rate. The low rate is 20%, the high rate is 40%. And what determines when you get how much is going to be taxed at 20 and how much at 40, that's determined by your number 2, your tax band or your cutoff point. And that is determined, number 2, the tax band is determined by your personal circumstances. Are you married? Are you single? Are you being jointly assessed with your spouse, etc.? I'll look at that on the next sheet. Then the third one is your tax credits. Once you know your cutoff band, then the tax credits are the next thing that are going to impact how much tax you actually pay. And again, just like the cutoff point, the tax credits are determined by your personal circumstances. And we'll have a look at the most common ones on the next slide. And number 4, pay-related social insurance, and number 5, the universal social charge. There are 2 additional taxes that you need to pay, and we'll go and look at how those are calculated when we get into the calcs part. You can see I've taken this sheet directly from the Revenues website, and this is the tax rates, the cutoff point. So again, this is what determines how much you pay at 20% versus how much you pay at 40%. And as you can see from the side here, it depends on your personal circumstances. So I would recommend getting advice if you are unclear on any of these. And if you're married, you also want to take advice whether you and your spouse, if your spouse is also working, if you should be jointly assessed, and making sure that you're maximizing the taxes between you. And that's exactly the sort of thing that your accountant will help you with. And then we look at tax credits, allowances, and reliefs. And again, these are based on your personal circumstances. So something that you do want to take advice on to make sure that you are claiming all of the allowances and reliefs that you are entitled to. For our tax calculation, we are making these assumptions. We're using 40,000 as the cutoff point, and we're going to have a single person tax credit, 1,775, and the earned income tax credit of 1,775. And that is, the earned income tax credit is for self-employed people and certain classes of directors. So again, remember what I said, you take advice on what your circumstances are. But again, this will, once you have that information, this is what you'll use to make your calculations. We're assuming Class S for PRSI, which is 4%. Class S is for self-employed people and directors that, again, certain types of directors. Universal social charge, there's various, and we'll cover those calcs in the next slide. So we're assuming here a profit of let's say you're a sole trader, partnership, your profit is 50,000, or we're assuming a salary of 50,000. And we've said the cutoff point is 40,000, and the tax credit, the 2 combined, is 3,550. First, we're calculating the tax at 20%. So 20% times 40,000. So that's 40,000 because our cutoff point is 40,000. So the first 40,000, we are taxed at 20%. And then over that, so we have 40, take that from 50 gives us 10,000. So 10,000 is being taxed at the higher tax rate of 40%. You can see, how quickly that adds up. 40,000, we're paying 8,000, but 10, we're paying 4 on it. So our total tax is calculated at 12,000. And this now is where our tax credit comes in. So we take the tax credit, which is 3,550. We subtract that from the total tax, and that gives us 8,450. So you can see why making sure that, first of all, you have the highest cutoff point that you can, that you're maximizing that with all the allowances you're entitled to and sharing it between you and your spouse. And the same with your tax credit that you are claiming for everything you're entitled to. PRSI Class S, we take the whole 50,000 and we times it by 4%, and that gives us 2,000. Then the universal social charge, this works in bands, in different rate bands. So I'll show you here. The first 12,000 is taxed at 0.5%. The next 10,908 taxed at 2%. The next 47,124 is taxed at 4.5%. Anything over that would be taxed at 8%. Again, so it is important to make sure that these calculations are right for you. The universal social charge, I think the main thing that impacts that is your age, but again, take advice on this. This gives us a total income tax, PRSI and universal social charge of 11,947. That's based on a profit or a salary of 50,000. You can do this calc on CloudPay. CloudPay is a payroll software that integrates with Sort My Books, and they have this fabulous feature. When you log in, it's a quick calc, we call it, and you can put in your numbers there and to get this calculation. If you see, again, but we started out with 50,000 profit, we've 11,947 is tax. What you get to keep is 38,053 euro. So overall, the percentage of tax on that between all the different tax types gives you about 24% tax rate. So you might be thinking, that's horrendous. Is there anything I can do about that? You know, again, this is where the fancy tax consultants come in, but one key one is to pay into a pension. And a pension has so many rewards, because if you put 10,000 of that, so you take your 50,000, you put 10,000 into a pension, it means that you are not paying it reduces your salary now to 40,000. 40,000 is what you're now being taxed on, which, remember, doesn't have any over the 40%. It's all going to be at 20%. So for you putting 10,000 into your pension, 5,600 has come from you, and the tax is covering 4,400, because otherwise you'd be paying the tax on it. It does mean, however, that you need to have 17,097 euro in cash in order to first pay the tax office and then pay your pension. Or if you're a limited company director, each time you're paying your salary, make sure you're also making a pension contribution. But it does mean that that's going to future you, and less of it is going to the tax office. So when you think of it like that, you know, for 10,000, you would only be getting 5,600 of that, and the tax office would be taking 4,400. So really, if you could divert that whole 10 into a pension, yes, you don't have the money right now, but in the future, it'll be worth a lot more. We have a spreadsheet here that can be helpful to you to do some basic financial projections. You only type in the blue parts. Once you know, remember now you know how to calculate your tax. So when we put profit I need, that's the gross, that's your gross pay. So you can either do, we've done it weekly. So we've divvied out the week, and it's 50,000 divided down by week is 961. So then you put down, like I said, only type in the blue bits. So you put in, what are your business costs for the year? What does it cost to run this business before you ever start making money? And then down below you see, but what we're trying to get to is, what is your hourly rate and what sales do you need? So how much time off do you need during the year? And remember, there's 10 days of public holidays that you likely won't be paid for. And then if you're taking the standard 4 weeks off, you might need a dish. That's 6 weeks minimum. We've put in 9. We figured there's other family time that you're going to need. And when it says, I only want to work 4 days, think about it. You're probably not able to charge for every single day. So there will be days that you're working on your own business, you're working on getting new customers, that sort of thing. So put in how many days a week are you going to work? And then that will give you what is your sales price based on, we've got weekly sales units or daily sales units. So if you're doing a daily rate, for example, or this is based on an hourly rate, and that just something simple there to give you an indication of what you need to charge out in order to make the income that you're looking for. And finally, I have to add a disclaimer. Remember, I am not an accountant, definitely not your accountant, and this video is for education and information only. We can show you how tax is calculated. That's what this video does. What we can't help you with is what are your entitlements? What are your tax credits? What's your cutoff point? That's not something we can help you with. That's based on your personal circumstances, and for that, you need to take expert advice. I hope this video has been helpful for you, and I look forward to seeing you on the next module.